Welcome to the daily update, where I'll go over the action in the market for Wednesday, October 2nd, and then we'll see how things look for Thursday, October 3rd. Yes, I've been incommunicado. I was in Israel over the weekend after I heard about um, the death of Nasrallah. We decided to change our plans, leave Israel 3 days early, and spend the next 4 days somehow going through a very roundabout way back to where I currently reside. I had no internet connection during that time, so I couldn't even look at things, let alone do videos. But now I'm back in the swing and back where I normally prepare the videos. Okay, so before I get going into how things are looking right now, there's a thing called the SPX Investing Program. It's up, it's going, it's free, but that's going to change probably early 2025. I'm also looking at doing a live version of the basic course some point, maybe later in October. If you're interested in that, it's free. You're welcome to tune in. If you want to learn more about the website, there's a link that will take you to the website. There's also a video about the program that I have. If you have any questions, you can email me right here. You do get immediate access to the daily and weekly videos as they are prepared. Last weekend, I didn't do any of the extra weekend videos, the deep dive video and the what to watch video. I that's when everything changed and had to pack up and bolt at that time. And so that was not prepared over the weekend. But now that things are supposedly back to some kind of normal, when you're a member of the program, as soon as the daily video is available, you're free to watch that. The same thing is true with the weekly videos where they're delayed going public on YouTube and Rumble. Okay, the daily video is really, if you have the time and the determination to really understand what's going on in the market, the daily video is what I would recommend. Yeah, I cover a lot more stuff. I cover a lot of charts. I lean heavily on technical analysis. Going into my fourth decade of doing this, it's time tested. It's what you really need to do to really understand what's going on. If you're looking for quick answers, these videos are not for you. Okay? If you really want to do well, if you really want to understand what's going on, these videos are for you. And the daily video is the real foundation. And all the other weekly videos are meant to tie into the daily video. Okay, let's go back and talk about what happened, and then we'll look through the charts. We did have a lower open on Wednesday. Prices dropped down to S1. It found support at that level at 56.74. Then we climbed back to the unchanged level. We're actually be able to get above that and go positive, but we had some problems at the daily pivot at 57.16. We declined back below the unchanged level to go negative again. We found support at 5,700, nice little round number there. And then we climbed back. We closed positive, virtually unchanged, but enough to have a positive close, which is helping a few of our indicators. But we still closed below the daily pivot. All right, we were up 0.01%, virtually unchanged, but it goes in the books as an up day. We were below average with volume. Now, as far as the technicals, we're starting to see some weakness. One of our major indicators, a primary indicator, the parabolic SAR, has turned negative. We're also dropping below zero with the S&P McClellan oscillator and NYSE McClellan oscillator, which those, when they go negative, that starts turning the summation indexes down. So we're concerned about that. We are seeing weakness that's coming into the market. Whether it's going to lead to more weakness or are we going to be able to bounce up and recover from that, that's kind of the big question that we're trying to answer right now. Inflation seems to be under control according to the market's interpretation of that. Interest rates, they've been going back up a bit now with the 10-year yield, but we're going to get the big employment situation report on Friday, and that's going to be very telling. And that's what the market is fixated on now. It's what I will be watching very closely because the rest of the economy seems to be okay for the time being. It's the employment situation report. If that starts to really show that employment is weakening, that means we're going to probably head into some more difficult economic times. Now, again, remember, there's your version of what's going on in the economy, which could be completely different than the market's version of what's going on in the economy. There's a real disconnect between the two. We focus in this video on how is this applying just to the market itself. We are watching geopolitical things. Of course, I got to experience that firsthand in Israel. Things really started to escalate. Fortunately, I was out of the country about an hour, hour and a half before things really started to turn. Flights were canceled, and it was just, well, I mean, it could have been worse. I went from Israel to a very lovely, beautiful island for 24 hours in Greece, and then from there to Berlin, Germany, which is one of my favorite cities from a historical standpoint, and then a very long bus ride back to Lithuania before coming into Belarus. So I make that sound simple, but it was a 4-day journey, and with a lot of sleeping in airports and airplanes and bumpy buses and all that. Anyway, okay, we want to watch what's going on there in the Middle East because that's oil starting to go back up, and this could escalate. Now you've got Iran and Israel going more directly at it with each other instead of the Iranian proxies with Hezbollah in the north and Hamas kind of to the south there. Now they're starting to duke it out with each other, and that could really have a chance of escalating things, or it could calm back down. We just want to keep an eye on what's happening there. Okay, let's go back and talk about this. So, because of the Middle East escalation, oil is climbing. Now, it's not shooting up, it's not spiking, but we did get back above 70 there. We do have a confirmed Hindenburg-Ullmann signal. It was confirmed on the 12th of September, and that just kind of hangs back there for a while, and we'll just see if it develops into anything. And we're also typically in a period of weak seasonality. Now, we're going through a positive time right now based on other research, but I'm talking about the end of September into October. That's kind of a general weak seasonal time, but we have positive periods throughout that time, and I'll show you some seasonal charts near the end here. We still have the slope oscillator. Now it's starting to turn over. It's starting to roll over. So momentum is showing a little bit of weakness there. It's still positive and it's still giving us a very high reading. That's why it's on this list. Our stochastics, they're coming down too, but we still have some areas that are extreme positive. We already have extreme oversold, extreme negative with the Stoch RSI. Intermediate term, the TTM squeeze, it's still looking, and I have a longer term chart to show you there, but extreme positive. If we see some more follow through weakness, that could start to come down. PMO studies haven't quite rolled over. Bullish percent index, it's giving us a very high reading, but now it's starting to come down. The money flow, same thing. And then the 10-day moving average of the new highs, new lows for the S&P, that's still giving us a very high reading. Long term, we're still looking at the 150 and 200-day simple moving averages, still above what I've marked as an extreme positive reading. They are coming down, but they're still extreme. And then the exponential moving averages as well. And we'll go through all these charts here. This is the current scenario, which has not changed to this point. That the Fed came in, they cut rates 0.5%. There was some talk about maybe a couple of 25 basis point cuts between now and the end of the year. The market, of course, wants more than that. Give me more. There's no greed going on there. And to this point, the soft landing scenario that we will not go into a recession seems possible, but that can change. And Friday's report may give us some insight as to what's happening there. The dollar was up after really going down, and that was helping stocks. Now it's bouncing back up a little bit, and that could be pressuring stocks. And interest rates, this should be up. They were actually up from 3.79 to 3.79% from 3.74. That's kind of a big jump in one day there. The 10 to the 3-month yield curve is still inverted. The 10 to the 2 is uninverted. I'm not showing those charts for right now because that's the takeaway from the charts is what I've stated right here, that one's still inverted, the other one is not. We didn't change from sentiment because we were virtually unchanged on the day. We were at 68. We're still at 68, which is positive for the time being. And this is another little concern here. We are in a positive trend. The green line's on top. But since we're seeing some weakness now, the ADX has dropped back below its moving average. And so that suggests a weakening trend. But we are still trending since we're still above 20 for right now. With the down day, And we've kind of had a bit of a rough week so far, at least in Wednesday session. I wasn't able to watch this really closely. I'm just going back and looking at the charts, but we're now negative here with the bias. Even though we had this slight tick, we spent most of the day negative. Okay, and I'm keeping our momentum at mixed right now because we could be going through a shift of going from a more positive environment to a negative environment. Now, a good solid update. The employment report comes out. The market really likes that on Friday, and we shoot higher. That could switch everything back to positive. We just go with what we're seeing right now. We want to be aware of that. So if we see more follow through downside, we're not being caught off guard. We're being proactive instead of reactive with this. Okay, the reports that came out. Every week we get the MBA mortgage applications. They were down 1.3%. Last week they were up 11%. And the ADP employment change. This is encouraging. But sometimes the ADP employment change and the employment report on Friday contradict each other. So, but we just take what we have right now. They came in at 143,000, more than the 120,000 they had expected, and up from 103,000 that we saw last time. This is suggesting from this report that the employment situation is doing okay. Here's a chart of the weekly mortgages where they're actually down. The last couple of weeks have been positive, even though we've been kind of trending lower over the past few weeks. This is the ADP employment change, which really shot up. We had been declining overall. Going back to March here, you can see we're kind of going down. Now this came back up a little bit, and that could be encouraging for the economy, which could also be encouraging for the stock market. Now, I'm going to have a few extra charts in here because I didn't do a video for Tuesday or Wednesday. So I went back to Isabel Net and looked at some of their charts. So there's a few extra in here. Just the first ones that I show you are the current ones for Thursday's session. This is just the annual change in earnings is the best indicator. I show this chart from time to time. This is what drives stock prices. If earnings are going up, and that's what we're seeing, even though it's chopping around a little bit here, but the fact that this is going back up, this is really helping things. This is helping the S&P to go higher, and this blue line is continuing to be positive as well. And you can see this is a long-term chart where there is a definite correlation between the S&P going in the same direction as earnings. Okay, now here. Welcome to the best first 9 months ever in an election year. That means we're now in October. So we're looking pretty good as far as this is concerned. And I could have put this in the seasonal side, but this is just one of those charts that I'll show once and then go on to the next one. Here's a different look at the S&P 500 daily chart where they do the cup and handle. I don't do that as much. They also have some target levels if we continue to go up and some support levels if we continue to go down. The moving averages here, this is the same as what I plot on a lot of different charts, but we're kind of really watching right around this 5,700 level-ish or so. That's psychological, and the more we hit that and use it as support or resistance at some point, the more technical that will actually become as being valid. But for right now, it's still more or less psychological. Okay, then looking at in purple is the S&P year over year, and we're kind of coming down a little bit, but we have been bouncing back up with the ISM manufacturing. We're going to get the non-manufacturing in Thursday's session. Okay, then gold ETFs have seen 24 billion of outflows from the peak in 2020. This is just showing a disconnect where we're seeing gold going up and setting all-time highs, but folks are not as enthused that maybe they've been burned before. They've listened to these doom and gloomers, which tend to hate stocks and love gold, and they're tired of getting burned time after time. And now they're kind of being left behind. Even though we're seeing some money going into gold right now, it's not necessarily keeping up with the rise that we're seeing in gold. Okay, big inflows into the emerging market debt and equity funds. So we're seeing a bit of a pickup in emerging markets. And then buybacks also coming in still very high. That's positive for the market. And then the sectors announced buybacks. Most of tech, this is where you hear most of the buybacks from, like Nvidia, Google, the big companies, they go in and they buy back their own stock. And that's usually positive on things. With financials next, which has been another stronger area. Healthcare, which is more defensive, discretionary, we're seeing it there. And then the other areas, we're not seeing as much in communication or staples right now. Then this is kind of a different way of reflecting how do we break down the 11 sectors that make up the S&P 500? And this is by equity capitalization from 1975 to 2024 as of the end of September. So you can kind of look at this and go, what's going on here? All these crazy lines. This is just showing how much of an impact on things and then how much of a percentage on equity capitalization, market cap, is there in this. And you can see tech. That's why we pay attention to tech. I don't do my strategies around the Qs or the NASDAQ 100, but I sure watch that area because the stocks that are in the NASDAQ 100 are also in the S&P 500. So we want to watch that. We're watching healthcare. We watch staples. We watch all of these things. And then in the intermarket analysis video over the weekend, when I am able to see, I think I was able to do that one. That's why we watch these areas, because we don't just want to be filled with useless information. We want to keep an eye on these other areas because one area might be doing really well, but the percentage, like energy, is not a huge factor into the calculation of the S&P because their capitalization is a lot smaller. So that's why we keep an eye on this. Okay, then number of weekly gains. This is one of the older charts going back over the past 48 weeks. We're looking pretty good here, maybe a little too good. We're coming up to this dashed line, which times in the past has suggested a top. Cyclicals versus defensives. Now, cyclicals, they do better when the economy's doing good. Defensive, staples, healthcare, things like that. That's why we're keeping an eye on the relationship between the two. Well, right now, cyclicals have been doing better because the economic reports have been doing better. If we see this start to go down, that means the market is getting more defensive. Now, there are areas that we've been watching, staples, utilities, healthcare. They're doing very well by themselves, but we watch them in relation to how are they performing with the S&P 500. And for right now, the cyclical areas that benefit from the economy doing better are outperforming. And this is really kind of crazy. The takeaway is the dark blue line here. It says the rolling S&P 500 performance since 2000, it's been rebased to 100. 2024 has seen the strongest gains of the 21st century at this point in the year. That's why it's at the top. Then, and this is another area that we've been seeing, but this kind of confirms that the Magnificent Seven stocks, they've lagged since July. That's why the S&P is having trouble breaking higher. But it's also holding up because it's the rest of the stocks in the S&P that are doing better now, but they don't have as much of an impact on how the index is calculated. And since July, we are showing kind of a laggard here. Okay, here's the Magnificent Seven. Then we have just some other areas that have actually been performing a little bit better as of late. Okay, I just haven't had the time or patience to deal with Twitter lately, so I'll try to spend some time on there and see if there's any useful charts, but not now. Okay, so I wasn't able to do a video on Tuesday, and this was quite negative. We had a nice little open there and then saw a bit of a sell-off, but we saw a bounce back on Tuesday where we did gap lower. We got down to S1. That was the low, and we bounced up off of that. Then we were kind of dealing with the daily pivot here. We broke down below the unchanged level only to come back. So most of the action was just slightly positive or slightly negative. We did go positive near the end of the day, but we closed down below the daily pivot. Here's the intraday chart, and I'm not seeing where we're a little down a little bit in the initial overnight session for Thursday there, and we're still concerned about this. The red line is above the blue line. That means that intraday value is outperforming growth. Now, we want them both to go up, and the market can still go up even if the red line is still above the blue line. But in a more solid environment, we want the blue above the red. And not really showing a real improvement here intraday with S&P growth to value. We want this to continue to go up intraday. End of day, we were up with growth where value was down. With the mid caps, growth was up more, and the small caps, growth was down, but down less than value. So not really seeing much of an improvement with our small cap to growth to value ratio. Mid-cap growth to value ratio not seeing an improvement, ticking back up and holding up okay with S&P growth to value. But again, we want this ratio to really go up to drive the index higher. If this turns and starts to go down, that could put more pressure on the S&P to go down. Looking at growth of value, the ETFs that we have here, after showing some improvement and coming back up into the rainbow, now we're starting to drop down below the rainbow. That's not positive for the S&P. This is encouraging still. Discretionary to staples. We are seeing a big improvement here. If that could continue, that will be more positive. It's kind of a pseudo growth versus value area. Large cap growth, even though it's been declining, is still above all the moving averages here and hanging up for the time being, hanging in there for the time being. This is where we're a little bit concerned. We saw the ADX above its moving average, and now it's starting to roll over. The green line is coming down, but it's still on top, so we're positive, but this is not a real vote of confidence for the time being. Short term, also crossing below the moving average, the green line coming down. The red line's not really coming up, but it's not declining either right now. So this is a little bit of a concern. And we're dropping to below average with volume now. We did get the latest reading from Investors Intelligence, 2.62, a little bit north of neutral there. And starting to go back up overall when we look at the VIX, but we're still below the 20 level here, both with the line chart and the bar chart. The VIX of the VIX starting to go back up when the VIX goes up as well. And the momentum of the VIX has now gone from being down to up as measured by the MACD. This is an updated historical chart here. This is red. This is what's been happening with the VIX. And we still have some difficult times ahead seasonally, because when the VIX is going up, that means stocks are going down. We're still getting a signal here on the SPXInvesting index. This is a variation on the VIX. It's coming down, but we're still in this red area where the market is anticipating that there's still a big move yet to come. We had gotten a very high reading. Even though we're coming down here, we're still in that area to be watching this chart. And I tried to update this a little bit. It was getting a little unaligned here. But this fear gauge actually ticked down just a little bit. And there should be another fear gauge somewhere in here that I didn't look at yet. Okay, we're starting to go back up now with the equity put call ratio daily chart. And after getting extreme here, we're starting to go back up with the 5-day, and the 10-day is just barely starting to go back up. Even though it declined a little bit on Wednesday, I have to try to remember what day it is here. Unless I write it down, it feels like I don't know what day it feels like. But anyway, okay, now we were going back up with our risk on versus risk off ratio. That's more positive for stocks. Now we're starting to come down, even though we bounced back up on Wednesday. We're seeing a pickup in volatility risk premium. This could also suggest a warning sign for the S&P. We are rolling over a bit here with the advanced decline line based on price and volume, but we're still above the advancing moving averages. So we're showing some weakness, but not a breakdown, at least yet. We're still seeing many more new highs than new lows, but our 5-day, because we're seeing a contraction here, it is flattening out, and we're starting to decline with our 10-day moving average. And we're declining, but still above zero with the advanced decline ratio. So based on price, we're still positive, coming down, but still positive based on volume. And we're still looking good here. The accumulation distribution above an advancing moving average. And the boom indicator is no longer extreme positive. This is encouraging too. The Chaikin money flow. The red line's been going back up. And this is suggesting the smart money is coming in and doing some buying. And we're after chopping around for the last few sessions here, we're trying to turn back up here with the Chaikin oscillator. But this is a concern. We're on top with the vortex, so we're positive with the green line on top here. But it's really coming down as the red line is coming up after being extreme negative. Still looking okay here with the S&P 500 advanced decline line based on a cumulative measurement here. Ticking down a little bit, also based on volume, ticking down, but not really breaking down. We're seeing no real disconnect between the S&P 500 and the NYSE advanced decline line. The new highs on a daily score are still positive, and the 50-day is still going up. The 10-day is also giving us a very high reading. And we're still, for the most part, still going back up here with our other 50-day moving average of the new highs minus the new lows for the S&P. The NYSE cumulative advanced decline line based on price, this is the broad market, and it's breaking out here still. even though we're kind of stalling a little bit with our regular NYSE advanced decline line, coming down just a little bit, but still looking solid with this other NYSE advanced decline line. The common stock did see a bit of a pullback here, and then we based that on volume. We're actually up with this. So to see price going down and volume going up, that's encouraging for the broader market. Here's the daily score, still positive there, even though it's coming down. And over the last 50 periods, we're still going up with this. And then looking at another broad market measure of a 5-period moving average of the highs and lows, still looking positive there. Coming down, but still above the moving averages on the advanced decline line studies across all the other indexes. We are declining with those stocks above their 20-period moving averages, but we're still above 50. So we're positive but declining. We're dropping below 70 to show that the momentum is waning for the time being. We're also declining, but above 50 with those stocks above their 50-day moving average. After getting extreme with the 100-period moving average study, we are declining, but still looking quite positive. Also declining after being extreme with the stocks above their 200-day moving averages. And we look at the ratio between large caps and small caps, we were up slightly, but we're not seeing any real decisiveness right now. We've been chopping around for the last few months. Here is the daily chart, just showing a little bit of a pullback, still above the 50-day moving average. We've now dropped for another day below average with volume. Coming down with the 20, 50, and we're still extreme, but coming down slightly here with the 200-period moving average study of the S&P 500. We're starting to drop below the green line and the blue line here with the condition of our 20-period moving average trend. Now, that's a concern and a warning sign to us. But when we look at the simple and exponential moving averages, we're still above both of those. We may be getting some support from the exponential moving average, the blue line, that moves faster. If we see more follow through downside, we're really going to be watching the 20-period simple moving average. And we're already extreme negative with the Stochk RSI. After being extreme positive, we're coming down with the Williams percent R, declining with the 14-period CCI, and also declining with the CCI based on 20 periods. And we're no longer extreme positive in the short term with the stochastic, coming down but still extreme in the intermediate short term, rolling over below its moving average, but still extreme positive with the long-term stochastic chart. Declining but still above zero with the force index, coming down but still above the midpoint with our standard deviations chart. We're right at zero with the balance of power. And the condition of the 50-period moving average, coming down, but we haven't fallen below the red line or the blue line, at least yet. We're above both of the simple and exponential variety of moving averages here. We're above all the plotted moving averages. So if we see more weakness, we'll be watching this as the first line of support. If we break below that, we're probably headed to the 50-period moving averages. And we've gone to more of a neutral stance with the no-go. It's positive, but it's gone from the dark blue to the lighter blue bars. And we're coming right down, but still above the midpoint with our highest high, lowest low values chart. We're getting above this black line. Now, as I always say, I put the black line on here. This is just in the past where sometimes we topped out at about this level, but we could continue to go higher. But this is still extreme positive for the TTM squeeze. We're declining, but still above zero with the ease of movement. We're flat, but positive with the Erin indicator, dropping below zero with the S&P McClellan oscillator. That's a warning sign to us because when that's negative, the summation index based on price is now going down, and we're also turning down based on volume. We're dropping below zero with the NYSE McClellan oscillator. So that's negative, and we're starting to turn down with the summation index for the NYSE based on price. Still looking pretty good here based on volume. This is another contradiction. We're above zero with the Swenlin trading oscillator based on price and going up. We're also above zero based on volume, but we're declining. So that's a concern to us. We're still positive with the momentum with the PMO, but we're rolling over. We've actually gone below the moving average based on price, rolling over, but still above the moving average based on volume. So we're seeing a bit of a decline here with the PMOs that are rising. The buy signals are declining. We're still extreme positive with the PMOs that are above zero. And that could be positive. That just means out of all the stocks in the S&P, the PMOs signals that we get from each one of those stocks is still giving us a very high reading. But this is big. The parabolic SAR now has a dot on top. It has switched to negative, and that's a primary indicator. We continue to be neutral with the Elder's Impulse system for the S&P. rolling over, but still positive and extreme positive because we're above this green line with the slope oscillator, which is a short-term oscillator. Rolling over, also still above its moving average, the MACD. That's more short to slightly intermediate term. And so we're seeing some weakness here in the short term with our momentum oscillators. The MACD, the PMO, PPO also showing some weakness, but still positive. Seeing a little bit of a rolling over here with the TRIX, a long-term oscillator, but still going up for the most part with the KST. Rolling over, but still positive with the Copic curve. After giving us an extreme positive reading, we're no longer extreme with the Sean trend meter. And starting to come down, we'll have to see if there's more follow through with this. After giving us a very high reading for the bullish percent index, now it's starting to decline, but it's still positive for the time being. Rolling over a little bit here with the NYSE bullish percent index, but still giving us quite a high reading here. We were flat, but we're declining after almost getting extreme positive with the NASDAQ 100 bullish percent index. We're declining, but still above 50 with the money flow, going up slightly and positive with the ultimate oscillator, kind of jiggling all around here, but still above an advancing moving average with on-balance volume. We're still above 50 with the RSI 14 and the RSI 9. And the blue line's still on top, meaning it's above the red line here. And that's positive. Coming down a little bit with the green line here, and we're still above the whole Ichimoku cloud. So we're seeing weakness, but we're still maintaining a positive stance with things. Still looking good here with the weekly chart of the S&P well above this R2 pivot level, but we're looking more negative on a trending basis. The Heiken Ashi is now turning to a dark candles. We're positive with the Kegi chart, but pointing down. That's positive with a negative stance there. But the Renko is still positive, but the 3-line break is starting to show dark or black candles here. That's turning more negative. Long term, coming down with the 150 and 200, but still above these red lines that I put on here. Still positive across the board with the Keller market model on all the different indexes and time frames that we follow. We're negative in the short term with bonds based on price. Commodities are still positive in the short term, but negative in the intermediate and long term. The dollar is bouncing back up, so it's turned back to positive in the short term. And we saw energy, tech, financials, and utilities positive for the sectors. Staples going down, that's actually encouraging because we're looking at the relationship between discretionary and staples. But staples or discretionary was down by the same percentage point here. So it didn't really improve things all that much. Awful lot of red here in the alerts that were signaled where we're crossing below 80. Now, I don't put that on the chart with the bullish percent index. I put it at 70. But we are coming down from that 80 reading, and that's seen as something negative. We did go below 5,700, but then we were able to get back above it. And we've got the NASDAQ just popping above and below round numbers here. Canada is doing pretty good, setting a new all-time high. And the energy, the BPI is now crossing above 30 after we had seen some weakness. This could be some geopolitical things that are happening. And we're seeing discretionary crossing below 80 with the BPI and staples going below 70. Not really seeing much of a disconnect here between the S&P 500 weighted versus the equal weight version of the index. And we're up just a little bit, but chopping all around right now. Now, you could take this as negative, that we're not seeing leadership by the really big stocks, but you could take this as positive because we're seeing the rest of the stocks still holding up well for the time being. The Dow, after setting an all-time high, is pretty much chopping sideways. Currently, we continue to be neutral with the diamonds for the Elders Impulse system. And we came down to this pivot point here. This is providing support for the NASDAQ, and we were able to bounce up off of that. Also came down to almost to the pivot point with the NASDAQ 100 and able to bounce up off of that. But we're still neutral with the QQQs with the Elders Impulse system. The momentum is still positive, but rolling over for the NASDAQ 100. And after coming back up and giving some promise, the small caps are back down. And we're right at 50 when we look at the Russell 2000 small cap index with the RSI here, still above the 50-day moving average, starting to cross over negative with the momentum for the small caps. And the Elders Impulse system for the last 2 days has been negative for the small caps. Not really seeing much of a change here with the mid caps. They continue to be neutral with the Elders Impulse system. After setting an all-time high last week, we are coming down slightly here with the Wilshire 5000, but still looking good. Also setting an all-time high last week and up slightly and still looking good is the total U.S. stock ETF. And we're juggling around here a little bit with the staples to tech ratio. And we want this to go down if we're more positive on the market. If this is going up, that means the tech sector is outperforming. Excuse me. If this is going up, that means staples are outperforming, and that would be more negative. Even though we've seen a recent, my goodness, a recent golden cross with this ratio, and that's a bit of a concern longer term. Now we're just watching it on a day in and day out basis to see if this is going higher or lower. The financial sector still looking solid for the time being. The FANG index still a ways to go to get back to its all-time high, but still above its 50-day moving average. We never were able to get above this short-term trend line, but we're coming close down now. I'm going to have to extend this line down to this longer-term trend line. Apple was up 0.25%, still above its 50-day moving average. We were down slightly, but Amazon is still above both the 50 and 200-day moving averages. And we're seeing this. This could be a concern. Microsoft coming down just a little below its 50-day moving average. We could be getting ready to see a death cross here, and that could be significant. Meta, still probably the best looking chart that we look at of the Magnificent Seven, still looking good there. Above the 50-day moving average with Google, but we're concerned about this possible death cross here with a moving average crossover. NVIDIA, it's still above its 50-day moving average. And Tesla, which had been showing a real improvement here, was down 3.5%, but still above its 50-day moving average. And the other good-looking chart here would be Netflix, but hasn't really broken out from this previous all-time high, at least yet. And we're seeing a little bit of a tapering off when we compare on a short-term basis, U.S. stocks with world stocks, still holding up longer term with the correlation. Oil, after dropping down to about 65, has now come back up to 70. And we're watching this for geopolitical reasons, mainly. The dollar is in a downtrend, but after almost getting down to 100, has really been bouncing back up. And we're going back up now with the 10-year yield. We're coming down with the 10-year based on price. Not really seeing much of a change here with Qs to the S&P, slightly below its moving average with the growth to value ratio. Discretionary pulling back now, but still above an advancing moving average, and that's encouraging after it spent most of 2024 being discouraging, and dropping slightly below the moving average when we compare large cap growth with large cap value. So when we look at the large caps, dropping below the moving average, slightly below the moving average with the mid caps, slightly above the moving average with the small caps. And this is a concern too. We're seeing the S&P underperforming utilities. We want this to go up to be more positive for the S&P. And we're still going down overall with staples to S&P right now. We want this to continue to decline to be more positive. If this really turns and starts to go up, that'll be more negative for the S&P. And here is the Hindenburg-Ullman. If you want to find out the different criteria that go into that, here's an updated chart. We have not received another spike up here, but this is still a confirmation since we had 2 spikes within 20 trading days. So we're still working off of that for the time being. Other times when that happened was right before the COVID crash and right at the end of 2021. So what's our outlook for Thursday? We're still positive with our technicals, but weakness is developing. We have our McClellan oscillator below 0, the parabolic SAR below 0. We also have a confirmed Hindenburg-Ullman, and we are in a period, bigger picture now, of weak seasonality. We're going to get jobless claims on Thursday, and the S&P Global U.S. Services PMI, the final reading there. Factory orders, the big one is going to be the ISM non-manufacturing, and then the geopolitical things, keeping an eye on specifically Israel and the tension between Iran and Israel and the Iranian proxies, both in Yemen and in Lebanon and in Gaza. Okay, so then we're going to get the big employment report on Friday. Here's also another look at the economic calendar. Seasonally, though, we're positive for October 3rd. Across the board, Dow, S&P, and NASDAQ do have good days. Now, I haven't had a chance to go through this because I set it up for Tuesday's video, but wasn't able to do a video. We were up in January, and it follows when we have an up January, the rest of the year, when it's a presidential election year, tends to be positive, and we're still sticking to that. Okay, and when we were up with January, it's up almost 20% for the year. Now, the worst 6 months, we're now done with that. Now we're coming into a period of time that's positive seasonally for stocks. Over the last 73 years, We're up 60.3% of the time in October, down 39.7% of the time. I'll go over these other two areas when we get closer to options expiration. So the fourth quarter is here, which tends to be more positive for stocks, going from 1950 to 2023. Here's the new chart here, where we do see some positive seasonality right now anyway, during an election year for the S&P. This breaks it out here. When I first showed this chart, it was for September, which tends to be bad for stocks. And although we had a pretty good September, where October, the average return is 1%, and we're positive 60% of the time. Thursday is one of the more positive days of the week, and it's the most positive day so far in 2024. This is the Carson research, which now that we're done with September, I will be deleting this chart. Also shifting this a little bit forward here, looking into comparing 2024 with 2023, we could see some weak seasonality, but we could also see little bumps up along the way. This is looking at the election year for October going back to 1950, just like it was in September, 50-50, up 9, down 9. The average return is down 0.9%. The warning signs, which is something I've been talking about for quite a while, the confirmed Hindenburg-Ullman and weak seasonality. We're watching the defensive sectors and growth to value, discretionary to staples. And discretionary, yeah, we like that, but we want to see growth to value doing better. Now, here's where we're seeing some negative signs and some weakness entering. The S&P and NYSE McClellan oscillators and summation indexes have now turned negative. Parabolic SAR has also turned negative. Positive side, our smart money indicators looking okay. And the equity put call ratio based on 5 periods starting to go, actually, that's when, this is a mistake. These are starting to go back up. I didn't change them over to the warning sign slide. The advanced decline line, seeing some weakness, but still looking good for now. The oscillators that we follow, rolling over, but still positive. And we're seeing this contradiction here with the Swenlin trading oscillator going up with price, down with volume. And we're still extreme with the bullish percent index for the S&P, but now we're starting to decline. The NASDAQ 100 doing okay, still positive, and the NYSE bullish percent index is actually looking pretty good still. The vortex, we have the green line declining, and the red is now going back up after being extreme negative. The money flow, ease of movement, and ultimate oscillator, those are all still positive. And the momentum rolling over for the NASDAQ 100, but still positive. And the financial sector is still looking pretty good there. So our conclusion, we do have this confirmed Hindenburg-Ullman and weak seasonality, but we're still positive for right now with the S&P. In the short term, this is where we're seeing some weakness starting to develop, but we're still positive as long as we're above the 20-day moving averages. Intermediate term, this is where we see the parabolic SAR, we see the McClellan oscillator and summation indexes. Those are more intermediate term here, but for right now, we're still positive, and we're still positive in the long term. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.